Hi friends, welcome back to your channel. In last video, we have learned that what is depreciation. So to reiterate, depreciation spreads the cost of an asset over its useful life. But did you know that there are different ways to calculate it? Let's break down the most common types of depreciation and when to use each one. First, we have the most straightforward method, straight line depreciation. This method divides the asset's cost equally over its useful life. Here how it works. Suppose if you have an equipment for $10,000 and its residual value is $1,000 and the life expectancy is 5 years. So to calculate depreciation, you have to reduce the cost by this residual value and then divide it by the useful life. So in this case, it would be 10,000 minus 1,000, that is 9,000, divided by 5, that is equals to 1,800 each year. So it's simple, predictable and perfect for assets that lose value steadily over time, like office furniture or buildings. Next, we have the declining balance depreciation. Unlike the straight line method, this one depreciates more in early years. Instead of evenly spreading the cost, we apply a fixed percentage to the remaining book value each year. For example, suppose the equipment cost is 10,000, the depreciation rate is 20%, then the depreciation on year 1 would be the 20% of 10,000, that is 2,000. Now in the second year it would become 1,600. So how this 1,600 is calculated? The value of the equipment at the end of the year 1 or the book value of assets for year 2, it's 10,000 minus the depreciation of year 1, that is 2,000. So the book value became 8,000. So 20% of 8,000 is equals to 1,600. So by the example you can understand that the depreciation is charged more in the early years and it gradually decreases. It is perfect for assets like car or electronics that lose value very quickly. As you can see, this method captures the rapid loss in value early on, which is more reflective of how certain assets wear out. Now, let's talk about the units of production depreciation. This method links depreciation directly to usage. This method is useful for equipment or machinery where wear and tear depends on how much it's used. For instance, if a machine costs 10,000 and will produce 1 lakh units in its lifetime, then each unit will depreciate the equipment by 10 cents. So if you produce 30,000 units this year, your depreciation would be $3,000. This method ensures that the cost matches the actual usage, making it ideal for manufacturing industries. So, there you have it. We have covered the 3 most common types of depreciation, that is the straight line, declining balance and units of production. Each method serves a specific purpose depending on the asset and how it's used. Now, I would love to hear from you. Which depreciation method do you use or which one you find most interesting? Let me know in the comments below. Don't forget to like this video, subscribe to the channel and hit the notification bell so you never miss any of our financial tips and tricks. Thank you.